The Monetary Policy Committee meeting that ended on Tuesday, the committee decided to reduce the MPR from 14% to 13.5%. Is this good news for the Nigerian economy?
I believe it is good news because for close to 3 years, the monetary policy regime has been in a tightening mode, which meant that for those years, interest rates have been very high, which has posed very serious challenges for business in terms of cost of credit. The good thing about this is that the CBN, that is going by the outcome of the MPC communique, has stated that there is now a change in direction in terms of policy. The focus is now moving from pursuing or trying to ensure stability to trying to promote growth. So the emphasis now is on growth, it's on job creation, poverty reduction, economic inclusion, and economic diversification. That is very important, especially at a time like this. You know, growth has been very fragile. For quite a number of months, or close to a year or two, we are having growth that is less than 2%. Last quarter, we had it at 2.3%. Yes. And when you relate that to the rate of growth of population, you see that there's still a big... Yes, it's still quite a big gap. So this is a good time to focus on issues of growth, because it is through growth that you can create jobs. It is through jobs that you can reduce poverty. You know, it is through poverty reduction that you can reduce all these social problems that you have.
Exactly, issues of criminal,
yes,
criminality and security issues
crime,
as well.
Terrorism and all of that. You know, all these things are outcomes of idle hands, of joblessness, and of unemployment. So it's a very good thing, even though it may not be significant, because other key monetary policy tools are still intact.
Yes, I was going to come to that as well.
CRR is still at 22.5. The liquidity ratio is still at 30%, and this change is only 50 basis points, which is very marginal. Yes. But the important thing is the signaling, because signaling also has a way of influencing the sentiments of investors. If you are now looking in the direction that, okay, the monetary policy or the central bank is now giving a pointer to the fact now that the main objective now is to pursue the growth and, economic diversification and all of that. So the real content of it, or the import of it, is in the signaling that it gives.
Won't the CRR, for example, liquidity ratio and the rest of it, won't they affect the reeling out or the results that is expected from the reduction in the MPR?
It will affect it. But again, when you compare this new regime, which is a slight reduction in MPR, to the previous regime, when all the variables are constant, there's still a difference. I think there's still a content of this that is showing now that there's a tendency towards reduction or improvement in the liquidity, through the reduction of MPR. It's a very slight movement, but the direction of the movement is what we commend. The fact that it's giving a signal, a pointer as to what direction the central bank is going, is also something that is welcome. But the challenge now is how to now transmit this policy measure into benefits to those who are actually borrowing money from the banking system. Because it's one thing for the CBN to announce these policies. It's another thing for the benefits of this to be transmitted to the real economy, to investors and all of that. Because that has always been an issue. We have seen a time in the past when I think there was an adjustment in CRR or some of these monetary policy tools, and the impact was not felt at the
lower pyramid.
At the end user level in terms of the credit access or the lowering of credit. So that challenge will still be there. But it's still one step at a time. By the time we do this, then the CBN can now also step in to see what kind of framework can be put in place to compel the banks to take a cue from what the central bank is doing.
Well, one step at a time, like you said. And in terms of productivity, should we start expecting or seeing an increased level of productivity in various sectors, the agriculture sector, manufacturing, telecommunications, and all other sectors?
So if you listen to the Central Bank of Nigeria, there was this emphasis on the need for the fiscal authorities to also bring something to the table. You know, because monetary policy alone cannot do cannot do the job. You can't achieve all the results that you want to achieve in the economy or in the real economy simply by adjusting monetary policy variables. So you need the fiscal authorities to bring something to the table. Because we are talking about investment. Investment is not just only about credit. It's also about the totality of the investment conditions, investment environment. So it is the tax authority that needs to put something on the table in terms of the tax environment. The trade policy formulators also need to bring something to the table in terms of the right kind of trade policy regime. You have issues of infrastructure, issues of power, issues of transportation, issues of logistics, issues at the ports. These are also critical elements
that could serve as bottlenecks if they are not.
Exactly. If those problems remain, there's very little that monetary policy can do in terms of achieving the main objective of promoting growth and creating jobs.
All right, and in terms of the currency rate, although the CBN governor said there's no need to worry, but is there a likelihood of still sustaining our currency, you know, at a very good level while we are trying to tackle the issue of reduced monetary policy rate?
You see, typically, there is always a trade-off in some of these variables. If you want to relax liquidity, you face the risk of inflation going up. You face the risk of pressure on the exchange rate. You face the risk of pressure on reserves. So what is important is to make a policy choice as to what exactly is the most urgent policy objective. Do you want to stabilize or you want to grow? So the impression I'm getting from the statement of the CBN now is that a lot has been achieved in terms of achieving stability. So it's now time to transit to focus on growth. So the more we do that and the more we relax the tightening conditions, the likelihood is that there will be, you know, a risk to exchange rate and a risk to inflation. You know, that is the way it works. So there is always a trade-off. You can't eat your cake and have it. That is the way policy systems or policy dynamics in the economy is.
Okay, we know that we're still having issues of, although the minimum wage issue has been passed to the assembly, right? But if this is not tackled, how can it or how would it invariably affect the MPR that has just been reduced?
Well, if we have the minimum wage implemented, and that is why some people have argued that sustaining the current direction of policy may be difficult, because the implementation of the minimum wage is likely to push up liquidity. It's likely to, you know, put pressure on prices, put pressure on exchange rates, you know, depending on how well it is also implemented at the states and at the federal level. If you have the two tiers of government and the local government level implementing it, it is likely to have some serious liquidity effects. And that may lead to the challenge of sustaining the current posture of policy, you know, with the Central Bank of Nigeria. But we see how it goes. It's a noble objective, what the CBN has done, and of course, it's work in progress. And as the economy progresses, as some of these factors play out, we begin to know what exactly the kind of policy steps that the central bank will need to take.
Okay, and finally, what's your take on the rebasing of the economy? That issue was also raised.
Well, the central bank governor raised it. Well, I think the whole idea of rebasing is more academic. The whole idea is for us to have a clearer picture of what the size of the economy is now. You know, we have the nominal figures based on current prices. We have the real
figures and the nominal figures.
Based on maybe 2000 price level or some price level that are some years back. So rebasing will just give us a more current nominal figure.
Which of course I think the foreign investors foreign investors mainly would like to see for
Yes,
more
they may like,
confidence.
yeah, it will be useful. At least it will give a better idea, first of the size of the economy. It will give a better idea of the structure of the economy, the various contributions of the various sectors, because the economy is dynamic. A lot of things are changing. So a rebasing will give a clearer picture. And that could also help the way policymakers will respond in terms of policy formulation, policy targeting, policy direction, and the rest of it.
All right, thank you very much for joining me.
Thank you very much.
All right,
Thank you.
thank you.